Sydney's debt sheep are scrambling like rats. Martin North, John Adams, in the interest of people. John, you come up with some amazing titles, but this really takes the biscuit.
Hi, Martin. How are you going today?
Pretty good.
Excellent. So in the last few shows, Martin, we've been talking about how rapidly things are moving along. And we've obviously did what we did in our last show is talk about how a number of central banks have surrendered the fight to inflation. And yet Australia hasn't sort of done that yet. So we're still talking tough. Only in the last 24 hours has the RBA governor said that on the 5th of July, we're looking at either a quarter percent or a 0.5% increase in official interest rates. And one of the interesting things about today is ANZ has raised their fixed rates by 0.9%. So we are seeing some very dramatic moves in interest rate pricing, both at the short end of the curve around variable interest, but also in terms of fixed interest. And just to give you a sense about some of these movements in interest rates, I mean, last November, December, a mortgage borrower could borrow at a 5-year basis around 2.5%. And as of today, ANZ is saying if you want a 5-year fix, it's 6.5%. So just on that one scale alone, we're looking at already at a 4% increase. And again, so when you're borrowing in the biggest bubble in Australian history, these moves are having significant financial impacts right throughout the economy.
And just another way of looking at it, John, which I've been looking at, is the so-called borrowing power. In other words, for a given level of income, how much can you borrow? The borrowing power compared with last October, November is down now between 15 and 18% for most households. So in other words, people just can't get the bigger mortgage that they used to because, of course, the rates have gone up and so the affordability is just much less now.
Yes. Now, just so I'm consistent with what we've done in the last few shows, I am still suggesting that they are going to raise rates to a point where the pain becomes too much, then they will pause and then they will reverse course. So that hasn't happened yet. I mean, the markets are basically saying it's going to be the official cash rate could go up to about 4% by the end of the year. So it's a dramatic rise up. The RBA saying we are going to go all the way until we get inflation under control. And there's no sense of a pivot. But what I want to really cover in today's show is how will we know that the pivot is coming? And so what we need to be looking at is forward-leading indicators as to how severe is the pain. So they will inflict pain. So the marginal borrower, as the former governor said, Ian Macfarlane, or the late people to the party late around mortgages,
Yep.
They're the ones who are going to be bankrupted. They're going to be sacrificed. And the establishment is willing to sacrifice a certain percentage of the market. But once that becomes too great for the system, that's when they're going to say we've got to slow down because we're not going to kill ourselves in the process. So there's probably a few key indicators to look at. We're going to focus on one today, which is very important. So some of the indicators that I think are important is consumer confidence, which we know from the ANZ Roy Morgan survey is at recessionary levels. In terms of the new housing market, new estates, new developments, etc. Now, there's a lot happening in that space, and we haven't covered that yet, so we want to cover that shortly. But also in terms of property listings, and that's what we're going to focus on today. And when it comes to property listings, there's going to be a couple of really interesting aspects as we go forward over the next 8 to 12 weeks. One is commercial property, and then obviously when it comes to residential property, there'll be those investors who want to liquidate their positions either because the cash flow of the property is not working in their favor or they don't want to be holding an asset that's falling in value. But also there'll be those owner-occupiers that are in financial distress and who'll be forced to sell because they can't afford the repayments. They can't afford the mortgage with the higher repayments. And so we're going to see some dramatic changes in listings. And one of the points that you and I discussed over the phone today was that listings is a better forward-leading indicator than credit, because particularly in a market like we have now where you have surging interest rates, and you're going to have more sellers. There'll be more people wanting to sell than more people wanting to buy. Listings, what happens is people will list first before people go borrow money, and so listings happens at a process step before borrowing, and that's why listings is a more forward-looking indicator than credit growth.
Yeah, and it's worth just thinking about listings because basically there are two things. There are new ones where people decide to put their property on, and there are existing ones that normally would get sold and therefore would reduce listings. So you've got those two forces, the up and the down. New ones coming in, things sell. So if there are more people listing new properties and less sold, then the total static count, as it were, goes up. And I think that's what we need to watch.
Yes. Now, what we're going to focus on today is we're going to look at some data from SQM Research, and we're going to focus on Sydney. Now, but not just Sydney. We're going to look at some of the surrounding suburbs, some of the surrounding regions around Sydney. So let's just put slide 1 on the screen. Now, the reason, Martin, why I think that some of these regions are important is because what we know, and particularly because we live in the Illawarra, so we have first-hand experience of this, is when the Sydney market becomes too hot, like it did, say, last year, but also around 2015, 2016 as well, a lot of people from Sydney get priced out of the city market, and then they move to regions like Wollongong, the Blue Mountains, Central Coast, and Newcastle, and so you start to see a whole bunch of strong property price growth there. So it's not just that Sydney has the most expensive and overinflated property market in the country. Some of these surrounding regions have also seen tremendous price growth, and so as interest rates go up, we're going to see some pain, not only in the Sydney market, but also in these other regions as well. Now, the other key point to make is that if we look at the daily index from CoreLogic, we know that the Sydney market was the first to peak, and it's the first one to start declining. So if we put slide 2 on the screen, what we can see, Martin, is that property prices peaked in Sydney on the 13th of February, according to CoreLogic. Now, Melbourne has also peaked on it was the 6th of March. The other capital cities have yet to peak and decline. So the first city in the country where we're going to really see this unfolding disaster manifest before the RBA says it's too much pain, it's going to be Sydney. And the way we're going to know how rapid that pain will be is in property listings.
And it's worth saying, of course, the CoreLogic index, as like all the others, is 6 to 8 weeks behind reality, right? Because it takes time for the settlements to flow through into the real numbers. So essentially what you're suggesting is that the fact it's tipping down, that's sort of going back 6 to 8 weeks, right? That's before any of the rate rises.
Indeed. So yes. So basically, what you're saying is that if property prices peaked in early February, we're talking potentially early December to early January as when the real peak happened, and there was a delay in the data.
Correct.
Yeah. Now. One of the interesting things, Martin, in terms of this SQM research is that it is collected at a particular point in time, and the data is collected at the first day of the month, and so what we tend to see is in a hot market, property is sold very quickly in say a 7 to 10 day period, whereas in a slow market, property tends to stay on the market a lot longer. So if you are taking a snapshot in time, what you will see is more listings happen in a slow market because they are not selling as fast. Whereas, for example, if you go, say, from the 1st of May to the 1st of June, you may have had a lot of properties being sold in that process, but they're not actually being captured in terms of this SQM research listing data. And so even though in reality there are more transactions and more listings in a hot market, the way the data is captured is actually an inverse relationship. And just to illustrate that, if we can put slide 3 on the screen. So what I've got here is the Sydney total residential property listings for going back to January 2010, and what we can see is that when the market is growing, because these properties are selling faster, the total number of listings on the market at the beginning of every month is going down, whereas in a market that is slowing or falling, the number of properties being listed per month are actually going up, because they're not actually selling. Now, over the last 12 years, we've had a couple of very interesting examples of where the market has been slowing and growing faster. And so in 2010, 2011, when interest rates were rising and we were at the peak of that interest rate cycle, raising cycle, which was at 4.75%, property prices were flat to slightly declining, and because property wasn't selling, that's why listings per month were going up. And then once we look at 2016, 2017, 2018, what happened in that period of time? APRA was really cracking down on some of the bank practices. They introduced a number of rules and regulations, prudential rules and regulations, particularly around interest-only loans, which was quite predominant then. And so that's why during that period of time, listings were going up. And then obviously we had the Royal Commission, and the banks got scared about what the Royal Commission could expose. And so that was another impetus during 2018 for the banks to change their behaviour. So, but the important thing about this period, Martin, was rates were still stable to going down. So even though interest rates were going down, the amount of transactions in the market were slowing in Sydney because the banks were changing their behaviour. And so now when we look at the pre-Royal Commission era, where the banks were just running riot in terms of their credit standards, that's when, say, from 2012 to 2015, there was a lot of aggressive lending by the banks, a lot of transactions, and that's why the properties were transacting faster and the listings were going down. And then obviously in the last couple of years during the COVID era, we've had extraordinary fiscal and monetary stimulus. We've also seen we've seen a decline in listings because properties are selling faster per month. And so that's that gives a bit of a sense as to how this data works and what these relationships look like.
And just to sort of re-emphasize it one other way, you can think of the listings number as effectively the stock of listings, right? At the point in time that they measure it, right? And there's new listings coming in, there's property being sold, but if it's a slowing market, the net result is more listings on.
Yes.
Whereas in fact, if things are being sold quickly, then the stock of listings drops.
Precisely, yes.
Yeah.
So rather than a flow diagram, so we're looking at the stock and not in terms of the flow.
Yeah.
Now, I mean, one of the really interesting things when I looked at Sydney and some of these regional areas was I was looking for what happened in the last 12 years at the peak of listings per month, but also when was the lowest part. So if we could put slide 4 on the screen, Martin, is one of the interesting things that I could see was that for Wollongong, Central Coast, Blue Mountains and the Hunter, the lowest number of listings at the beginning of the month happened only last year when the market was super hot. So we have Wollongong, Central Coast and Blue Mountains in August and the Hunter in September. So the interesting thing was Sydney had the lowest number of listings in 2015 when there was a lot of foreign buying. There was a lot of aggressive lending by the banks. So that's what we have there. But then when we look at when the highest level of listings were, when the market was at its potential slowest, interesting for Wollongong, Central Coast and Blue Mountains, it was at the peak of the interest rate cycle. But in terms of Sydney, it was when the banks really clamped down in terms of their lending practices. So slightly different factors there. But obviously we're entering into a period of where we're not only raising interest rates but super aggressively. And so what we can expect going forward is we're going to see a dramatic increase in listings over the next few months.
And it's worth, I think, again, underscoring, these property markets, although they've got some macroeconomic things quite similar, there are some significant differences in timing and trajectory, and it's true across the whole country, right? So I always talk about property markets, plural, rather than the property market, because as soon as you start talking about aggregate movements, you're missing these very important differences between, say, Sydney and Wollongong, for example, or Sydney and the Newcastle Hunter area, because there are some very important timing differences and also some different dynamics.
Yes. Now, when we were talking about this concept only in the last couple of days, we were talking about what was happening now in 2022 versus 2019 before the pandemic, because we know that the pandemic had a huge impact in terms of the market. So I decided to sort of have a look at that. And so we put slide 5 on the screen, Martin. What we can tell is that because the market was super hot in 2021, the number of listings in 2022 in May is way down compared to where we were in 2019. So 2019 interest rates were higher than they were in terms of the beginning of the month. So in terms of the beginning of 2022, but also if our viewers can cast their mind back, during this period of slow credit growth, property prices were actually falling in 2018 and 2019. So that's why there was a lot more stock on the market and staying on the market for in terms of longer. But the really interesting glaring aspect of this, there's only one counter trend, which is Sydney apartments. And so now obviously these numbers have been slightly I mean, these are not static, these are dynamic in the sense that we've had a lot of construction, and so obviously there is more stock on there, and so the numbers can actually change. But we haven't. So the one thing I should clarify is that in terms of these numbers, so again, this is May 2022. This is the beginning of May, before the first rate rise of 0.25% by the RBA, and obviously the 0.5% in June. And so before we even started to raise rates, we're seeing more properties, more units in Sydney, in the Sydney region being on the market compared to the pre-pandemic level. So as we start to now aggressively raise rates in this environment, the number of units being on the market will be quite significant. And I think in some of your conversations with Edwin Almeida on DFA, you've talked about how you're expecting the unit market in Sydney to be a bloodbath.
Well, it's amazing the number of listed units at the moment. And it's worth highlighting, of course, that a residential unit is a single apartment, right, or a single house, right? So, if you think about, they've just released, a new set of apartments, a new building. That could be 100 apartments, right? So that's why it's more chunky. But it's gone up and up and up and up. It's very unusual at this time of year to see that trajectory. Normally in the winter, things cool down a little bit, but not this year, particularly for apartments and particularly in the Sydney area.
Yes. Now, what we're going to do now is we're going to actually, because August last year for a number of these regions were they were at their lowest level of listings at the beginning of the month. We're going to actually go region by region and just give our viewers a bit of a sense as to how do these regions look before the interest rates increase. Now, we don't actually have the available data. SQM Research hasn't released the data for after the interest rate increase, and so we're going to visit that subject in that new data in a future post. But just before May of 2022, a number of key things happened in 2021, early 2022. So we had, if we put slide 6 on the screen, Martin, so we had in July of last year, the RBA deciding to not extend yield curve control to the November 2020 bond. And that obviously started to have an impact on fixed rates. Then we had the QE program slowing in September to only $4 billion per week. And then we had APRA changing their interest rate assessment buffer. So prior to October 2021, mortgages had to be assessed at 2.5%, above the current rate that was on offer, and then the APRA decided to change that from 2.5% to 3%, and then in February of this year, 2022, the RBA officially stopped quantitative easing, and all of those measures before official interest rates increase had a dramatic impact on terms of fixed rates. And so if we start to go into, say, slide 7, Martin, and we just start to look at the Sydney region, so we can start to see there is a uptick in listings because of all these measures that we've just outlined. But obviously, again, this data doesn't include what the interest rate increases that happened in May, in June, and what we're going to see in terms of July. So if we just consider Sydney, listings are up in terms of houses and units together by 33%. And so we obviously see an upward trend. If we look at slide 8 and look at Wollongong, again, Wollongong listings, and even though it's Wollongong, this data is more the Illawarra. It's up by 36.4%. If we go to slide 9 and we look at the Central Coast, quite a big jump there in terms of the number of listings, particularly for houses. It's up 88.2% from August to May 2022. If we look at the Blue Mountains, it's up 40%. Now, Blue Mountains property sector, that's a lot smaller in terms of the number of houses and apartments in terms of the market. And then if we look at the last region, the Hunter is up in terms of the number of properties listed by about 30.3%. So that works out to be about 1,200 properties. So we are seeing, Martin, that all of these changes that have happened in the pre-May interest rate environment, that we've started to see this uptrend of a slowing market, and listings are going up.
Yep.
And these listings are obviously coming from an ultra low base because the number of these regions, it was in August of last year, it was the lowest ever. That was the low point. And so the real question here is, so we're seeing listings going up, and this obviously started from August. We're seeing that property prices in February, according to CoreLogic, peaked, and they're starting to fall. And so as we go forward, you're going to start to see this whole market unravel quite quickly. And so, yes, we're going to see fewer building applications, approvals. You're going to see, obviously, fewer new housing estates, and in terms of a major contraction in the building sector. But then obviously you're going to see fewer people applying for a mortgage, and obviously I've spoken to banks and credit unions here in the Illawarra, and they say November last year it was red hot. Yep. Everyone's coming through for a mortgage, whereas now it's dramatically slowed.
Yep.
And obviously, as we go forward, we're going to see a dramatic increase in listings because people, according to your own data, a lot of them are very stressed in terms of their finances. And the question is, how many of these people can hold on in terms of holding on to their mortgage? Because once people get into financial trouble, the only option is, and obviously this is something you've said in a previous show that we've done, that banks are already having conversations behind the scenes with certain people and saying it's time to list your property because we don't think you're credit worthy to be able to handle the mortgage. So I think all of these factors are coming into a state of play where a lot of these people who got themselves into way too much debt, they'll be trying to scramble like rats. They'll be trying to exit the market, and what we're going to see is a very dramatic increase in listings, and these properties won't sell, and the longer these additional properties come onto the market and stay on the market, that's going to have huge downward pressure on prices, and that's how it feeds into each other, and that's obviously what happened in Ireland.
And it's worth just saying, John, that property investors in Ireland ran for the exits first because they didn't actually think about it other than it's an investment, it's not working, and I'll sell it, right?
Yes.
Whereas those who own the property as somewhere to live, they were a bit slower. They tried to hang on and essentially, pared back their spending elsewhere first to try and actually just survive. But eventually it got to the point where they were unable to keep the property. So I think we're going to see similar things here. In fact, I would suggest that some of the early rise in listings that we're seeing are from those investors who've just said, no, it's not working now. no further capital growth in property for the next period, cost of the investment property going up, time to get out and capitalise on the capital growth that we've seen rather than just hang on. But I'm also watching now for the owner-occupiers who will take longer, but they are coming on stream too. And with the higher rates, we know that rates are going to continue to go up. That means we're going to see higher listings.
Yes. Now, the really interesting thing, Martin, in terms of as we go forward. So remember, if we just cast our mind back to the slide we showed earlier in this program about Sydney. So we had 2 periods where listings increased. One when interest rates went up. The other one when credit standards were tightened in 2016 to 2018. Now, only in the last 24 hours has, I think, the British government basically loosened their credit standards in terms of people wanting a mortgage.
Yep.
That could be an interesting dynamic in terms of this market. But the real interesting thing will be is how does raising interest rates in 2022 in May and June and July going forward, how does this compare to the last interest rate increase cycle in 2009 to 2011? And so if we can put slide 12 on the screen, because I think we are really much in a perfect storm. So if we compare raising rates in 2022 compared to 2011, when for Wollongong, Blue Mountains and the Central Coast, the listings were at its highest, there are some very stark differences. So when we look at household debt to income, we were at 159.4 in December of 2011, and now, and again, this is the latest data from the RBA, we're at 186.2. Mortgage stress, according to your data set in December 2011, was 15.4, and now we're at 42.97. We look at inflation, annualized inflation to December 2011 was 3.1%, and it was going down throughout 2012, whereas now we're at 5.1%, and it's going up, and we're at a 20-year high in terms of official inflation. And then when we look at the cash rate, so during this interest rate tightening cycle from April 2009 to November 2010, the cash rate rose from 3% to 4.75%, which overall was a 58% increase. And yet only in 2 months, we've gone from 0.1 to 0.85, which is actually an increase of 750%. And the RBA is going to raise rates.
Yep.
They're going to go again. And even though these are short-term official rates, as we said at the top of the show, when we look at even in terms of fixed rates like ANZ, they are moving these rates quite aggressively. So the environment in 2022 is very, very different to where it is in 2011 and 2012 when listings were going up because of increase in interest rates. And so I think what we're going to see is listings coming on the market and staying on the market, and the number of listings that are coming on will be the growth of that listings will be more faster and aggressive compared to what we've seen over the last 12 years.
Yeah, absolutely, John. I think you're absolutely right there. And I think that the rate of change is the other thing I'd highlight. Inflation's roaring away. The rates are going up really fast. This is going to happen really quickly. And that's another factor to sort of throw into the mix here, right? Another reason why I think the listings will be extremely strong and prices, therefore, will be extremely weak.
Yes. So Martin, I mean, in terms of what the RBA governor said yesterday when he made some public remarks, he said he was going to pay close attention to in terms of what happens in terms of mortgages. So he wants to know whether people are able to pay their mortgage, and that'll be something that he'll be paying close attention to. But what I really think is going to be really key is people wanting to sell their property and to put on the market, particularly investors. Yep. Investors are not going to wait for them to be struggling on the mortgage to be in terms of selling their property. If they think that the market is falling and they're going to lose money, they're going to like I said, scramble like rats. Yep. And they're going to put it on they're going to put it on the market. So and so I think listings is going to be perhaps one of the best leading indicators in terms of how this market's going to evolve. So someone called me this afternoon and said, well, I've seen your shows over the last couple of months, and so you're talking about rates going up and then pivoting, and then they could go to a super easing policy where property prices go even higher. So how does one think about their decision in terms of this? And so what I would say is what people want to be looking for is, if you live in a particular area of Sydney or New South Wales or anywhere in the country really, but particularly in New South Wales, you want to wait and see where you can start to see a slowdown in terms of the growth of listings, because as those listings continue to grow month by month, then you know that the market is continuing to slow because these properties are not selling. The listings data is perhaps going to give you a better clue compared to, say, credit growth, to know when the top in terms of the market is. I'm going to be paying very close attention to in terms of the Wollongong market, Martin, because we know that in December of 2011 there was about 8,000 properties on the market then, and we're a lot lower there. We're a lot lower now compared to then. So as we start to see aggressive rates, I think we're going to not only get back to this 2011 high in terms of the number of properties on the market, we're going to probably exceed that, and then once we reach to that sort of level, I mean, that should give people a bit of a sense as to maybe now is the time to purchase. But I think as you start to see property investors flee the market and these listings are going up and the property prices come down quite rapidly like it is in New Zealand, that's probably the time that the RBA is going to start thinking, have we gone too far? Is it time to slow down, etc.? Or no doubt there'll be people in the property sector or the banks tapping on the shoulder of the RBA governor and saying, you've got to slow down because it's really killing the market.
Yeah, well, it certainly could well be like that. I think the RBA will, of course, continue to propound its inflation at all costs. We've got to beat it sort of story for a bit. But they will have to be looking at other data too. It's no doubt about it. And I actually agree with you. I think the listings information is one of the most critical pieces of information. It's probably the most forward-looking we've got, because credit will follow and home prices will follow. And of course, it's worth thinking about it. The credit information's about 6 to 8 weeks late because we rely on the ABS and the RBA to publish data the month plus after. And with the price movements, the real price movements are at least 6 to 8 weeks delayed. So actually the listings data is probably the most accurate forward leading indicator that we've got.
Yes. So we know that listings are going up. And so particularly if you are a property investor with a lot of debt and you think to yourself, is it time to liquidate? The earlier you list, particularly in this environment, the sooner you're going to get a sale, because as we go forward, as these rates go up, as sentiment continues to go negative, it's going to be harder to get a sale, but also it's going to be harder to get a sale at the price that you want.
Yep.
And part of, I think, what we're seeing at the moment is probably two important factors to call out. The auction market is dead,
yep.
Particularly here in terms of Wollongong and in terms of Sydney. So that's one of the reasons why we're seeing already, in terms of this data set we've shown today, that the listings are going up because things are not clearing through the auction process. But the other thing is that we're still seeing in the Wollongong market at least some vendors not willing to discount not willing to discount in terms of their pricing. And so I think as we go forward, there'll be a lot of people getting the message that whatever expectation they had about pricing, they will have to significantly discount. Otherwise, they'll be continuing to lose money because the market will be falling as we go forward.
Yeah, and I'll in fact be releasing a show in the next day or two illustrating across the country how asking prices are being dropped. And they're being dropped between, say, 5 and 10% on average at the moment, which is very significant, right? And that's another early leading indicator. People are desperate to sell, but the only way to sell is to be realistic about the price that you might get.
And when you say 5 to 10%, is that before the 0.5% increase or after? Or
so this is basically the data over the last week or two.
The last week or two
from the various portals, yeah.
Yes, and obviously, as we see on the 5th of July, potentially another 0.5% increase.
Yep.
There'll be a whole new repricing in July for property, and that'll be very interesting to see how quickly vendors and real estate agents, how realistic are they about the need to continue to cut price.
Yeah, absolutely. Well, it's a whole new world, John, isn't it? And we'll keep monitoring it and, watch for the signs, eh?
Absolutely.
Thanks very much, John. Martin North, John Adams, in the interest of the people. We'll see you next time.